I want you to imagine a world where the gas gauge in your car tells you that you have a full tank, but the engine sputters and dies the moment you try to merge onto the highway. You tap the glass, you check the needle, it says full, but the reality under the hood is empty. This disconnect between what the gauge says and what the car does is exactly what is happening in the silver market right now. The price on your screen, the spot price, the futures price, the ticker that flashes green and red, is the gas gauge. It is telling you one story, but the engine, the physical supply chain, the vaults, the refineries, is telling a completely different story. And right now, the engine is sputtering. We are witnessing a historic divorce. For decades, the price of silver has been married to the physical availability of silver. They walked hand in hand, but today they have filed for separation. We are seeing spot prices on the screen that suggest a market in equilibrium, or perhaps a market in a rally, but when you actually try to go out and buy the metal, you are met with a wall of silence. You are met with out-of-stock signs. You are met with premiums that make no sense. You are met with delays that stretch into weeks or months. This is not a glitch. This is the beginning of true price discovery. For 50 years, the price of silver has been suppressed, managed, and controlled by a paper market that trades hundreds of times more volume than exists in physical reality. But when the physical inventory dries up, when the cupboard is truly bare, the paper market loses its power. We are standing on the precipice of that moment, the moment where the illusion breaks and reality takes over. And reality is a lot more expensive than the illusion. Today, we are going to tear apart this market and look at the gears that are grinding to a halt. We are going to talk about the supply shock that is no longer a theory but a logistical fact. We are going to expose the breakdown in the wholesale market that the mainstream financial news is ignoring. We are going to discuss the inelastic demand from industry that is creating a floor under the price that cannot be broken. And we are going to have a very serious conversation about how you, the individual investor, can navigate this treacherous landscape without getting crushed by the volatility that is coming. Because make no mistake, when a manipulated market breaks free, it does not do so gently. It breaks violently. And if you're not holding on to something solid, you will be thrown off. Let's start with the concept of the phantom price. If you log into your brokerage account right now, you see a price for silver. Let's say it's trading in the triple digits or high double digits. That number looks real. It feels real. You can calculate your net worth based on it. But is it real? A price is only real if you can transact at it. If I tell you that water is 1 cent a gallon, but there is no water to be found, is the price really 1 cent? Or is the price infinite? Right now, we are seeing a phenomenon where the spot price is becoming a theoretical reference point rather than an actionable price. Dealers are scrambling. They are calling their suppliers and getting no answers. They are calling the refineries and being put on hold. When they finally get a quote, it is significantly higher than the spot price. This spread, the difference between the paper price and the physical price, is the stress fracture in the system. As the stress grows, the fracture widens. Eventually, the fracture becomes a canyon. In a full-blown currency crisis, the spot price becomes irrelevant. The only price that matters is the street price. We are seeing the early stages of this. Dealers are widening their spreads not because they are greedy, but because they are terrified. They are terrified of selling you an ounce of silver today at a certain price, only to find out tomorrow that they cannot replace it for less than 10% more. They are pricing in replacement risk. This is a term you need to know. Replacement risk is the danger that you sell your inventory and cannot get it back. When dealers start pricing in replacement risk, it means they believe the supply chain is broken. It means they value the metal in their vault more than the fiat currency in your bank account. This leads us to the refinery bottleneck. This is the choke point of the entire global silver market. There is plenty of silver in the ground. There is plenty of silver in old teapots and jewelry. But you cannot invest in a teapot. You need a standardized bar or coin. That requires a refinery. Refineries are industrial facilities. They have limited capacity. They cannot just turn up the dial overnight. It takes years to build a new refinery. It takes months to hire and train skilled staff. Right now, the refineries are overwhelmed. The demand from the retail sector, from people like you and me, has exploded. At the same time, the industrial demand, from solar, electronics, and automotive, is relentless. The refineries are caught in the middle. They are running 24/7, but they cannot keep up. This creates a backlog. When you order a monster box of Silver Eagles and the dealer tells you it will ship in 8 weeks, that is not because the dealer is lazy. It is because the silver literally has not been minted yet. It is still a raw bar sitting on a pallet waiting its turn in the furnace. This delay is critical. It introduces counterparty risk into a physical transaction. Usually, when you buy physical metal, the whole point is to eliminate counterparty risk. You pay cash, you take the metal, transaction over. But when there is a delay, you are lending money to the dealer. You are an unsecured creditor. If the dealer goes bust, or if the refinery defaults, or if the price skyrockets and they refuse to deliver, you are left holding an empty bag. This is why availability is more important than price. I would rather pay a $10 premium for a coin I can hold in my hand today than a $2 premium for a coin that might arrive in 3 months. In a crisis, 3 months is an eternity. Let's pivot to the 3 engines driving this chaos. The first engine is industrial demand. We talk about this often, but the scale of it is misunderstood. Silver is the most conductive element in the known universe. It is the most reflective. It is antibacterial. It is unique. The modern world, the digital world, the green world, is built on silver. You cannot have a net zero future without massive amounts of silver. Solar panels are the obvious one, but think about the AI revolution. Data centers require massive amounts of power and efficient cooling and conductivity. Silver is in the chips, the switches, the contacts. This demand is inelastic. I want to drill this concept into your head. Inelastic demand means the buyer is not price sensitive. If Apple needs silver to make an iPhone, they will buy it whether it is $30 or $300. The cost of the silver is a fraction of the cost of the phone. They cannot substitute it. They cannot stop making phones, so they pay. This creates a floor under the market. The speculators might sell if the price drops, but the industrial users will just buy more. They are the whales that swallow the supply. The second engine is monetary fear. This is the engine that is just starting to rev up. For 40 years, people in the West have trusted their currency. They trusted the dollar. They trusted the euro. They trusted the yen. They assumed that inflation was dead. They assumed that bonds were safe. That trust is shattering. We are watching the bond market implode in real time. We are watching deficits soar to levels that would make a banana republic blush. We are watching inflation eat away at the middle class. When people lose trust in their money, they look for alternatives. They look for hard assets. Gold is the first stop, but gold is expensive. A single ounce of gold costs thousands of dollars. It is hard for the average person to buy a significant amount. Silver is the people's money. It is affordable. You can buy an ounce for the price of a dinner. You can buy a tube for the price of a car payment. This accessibility makes silver the primary target for the retail herd when the panic sets in. And the retail herd is massive. If just 1% of the financial assets in the US tried to move into silver, there is not enough silver in the world to satisfy it. The price would have to go to thousands of dollars to balance that equation. The third engine is speculation. This is the engine that creates the fireworks. Speculators are trend followers. They don't care about fundamentals. They don't care about supply chains. They care about lines on a chart. When they see a breakout, when they see silver crossing $50 a hundred, they pile in. They use leverage. They buy futures contracts. They buy call options. This adds rocket fuel to the fire. It creates the parabolic moves that we love to see. But it also creates the danger. Speculators are fickle. They will sell just as fast as they bought if the trend reverses. They are the reason for the volatility. And speaking of volatility, let's talk about the flash crash. This is a warning. In a market this hot, in a market this vertical, you have to expect violence. You have to expect days where the price drops 10%, 15%, even 20% in a few hours. This is not the end of the bull market. This is the shakeout. How does a flash crash happen? It usually happens in the futures market. The banks raise margin requirements. This means the speculators have to put up more cash to hold their positions. If they don't have the cash, they are forced to sell. This triggers a cascade of sell orders. The algorithms see the price dropping, and they sell too. It creates a feedback loop of selling, but here is the key. While the paper price is crashing, the physical market is usually freezing up. During a flash crash, try to buy physical silver. You won't be able to. The dealers will pull their inventory. They will say, "We are not selling at this fake paper price." Or they will jack up the premiums to offset the drop in spot. So the spot price drops $5, but the premium goes up $5, and the price you pay is exactly the same. This is the market defending itself. This is the physical market rejecting the paper delusion. If you are a long-term investor, a flash crash is a gift. It is a sale. But only if you have dry powder. Only if you have cash on the sidelines waiting for this moment. If you went all in at the top, a flash crash is a nightmare. It tests your resolve. It makes you doubt your thesis. That is why I always preach position sizing. Do not put money into silver that you need for rent next month. Do not put money into silver that you cannot afford to see drop by 30% temporarily. Silver is a volatile beast. You have to be able to ride the bronco without getting thrown off. Now, I want to address the short squeeze narrative. You hear this a lot on the internet. We are going to squeeze the banks. We are going to break the COMEX. Is it true? Yes and no. The banks are indeed short a massive amount of silver. They use these short positions to hedge their books and to manage the price. But the banks are not stupid. They have deep pockets. They can print paper contracts to infinity. You cannot squeeze a printing press with paper money. The only way to squeeze the banks is to remove the physical metal. If the physical inventory in the COMEX vaults drops to zero or to a level where they cannot fulfill delivery requests, then the game ends. Then they have to declare force majeure. They have to settle in cash. This is the moment of decoupling. The moment when the paper contract becomes worthless because it cannot be converted into metal, and the physical metal becomes priceless. We are seeing signs that this is happening. The registered inventory at the COMEX, the metal available for delivery, has been bleeding down for years. It is at historic lows. The eligible inventory, metal stored in the vaults but not for sale, is also moving. Whales are taking their metal out of the banking system and moving it to private vaults. They are taking it out of the reach of the financial system. They know something is coming. When the decoupling happens, the price on your screen might freeze. Or it might go to zero. Or it might go to 1,000,000. It won't matter. Because you won't be able to trade it. The real market will move to the streets. It will move to the coin shops, the private dealers, the peer-to-peer networks. That is where true price discovery will happen. And in that market, the price will be determined by simple supply and demand. And since supply is drying up and demand is exploding, the price will be shocking. Let's talk about the scams. In every bull market, the sharks come out. When people are greedy, when they are fearful, they are easy targets. You will see ads for collector coins that act as investments. They will try to sell you a coin with a 50% markup because it has a picture of a panda on it, or because it is limited edition. Do not fall for this. Unless you are a professional numismatist, coin collector, stick to bullion. Stick to weight. An ounce is an ounce. The market doesn't care about the picture on the coin, it cares about the silver content. You will also see leverage schemes. People offering to trade silver for you with 100x leverage. People promising guaranteed returns. Run away. There are no guarantees in finance. Leverage can wipe you out in seconds. If silver drops 1% and you are 100x leveraged, you lose 100% of your money. It's that simple. Buy the physical metal. Own it outright. Eliminate the risk of ruin. Another danger is the fake guru. The internet is full of people who claim to know exactly what will happen tomorrow. They scream $1,000 silver by Tuesday. They do this to get clicks. They do this to sell you a subscription. Nobody knows the future. I don't know the future. I look at data, I look at trends, I look at probabilities. The probability is that silver is going much higher, but the path will be messy. It will be nonlinear. Do not base your financial life on the predictions of a stranger on the internet. Use your own brain. Do your own research. Understand why you are buying. If you buy because a guy on YouTube shouted at you, you will sell when he shouts something else. If you buy because you understand the supply-demand deficit, you will hold through the noise. Conviction comes from knowledge, not from hype. Now let's go back to the supply side. Why can't the miners just dig more silver? This is a common question. If the price goes up, won't supply increase? In theory, yes. In reality, no. First, geology. Most silver is not mined directly. It is a byproduct. It comes out of the ground when you are mining for copper, lead, zinc, or gold. This means the supply of silver is determined by the demand for copper and zinc, not the demand for silver. If the global economy slows down and we need less copper, we will get less silver, even if the price of silver is skyrocketing. This disconnect is crucial. Second, CapEx starvation. For the last 10 years, the mining industry has been in a bear market. Investors hated miners. They didn't give them money. So the miners stopped exploring. They stopped building new mines. They high-graded their existing mines, took the best ore first. Now the cupboard is bare. We haven't found a major new silver deposit in years. Third, permitting. It takes 10 to 15 years to take a mine from discovery to production. If you find a massive silver deposit today, it won't produce a single ounce until 2040. You have to get environmental permits. You have to deal with local governments. You have to build infrastructure. You cannot just flip a switch. So even if silver goes to $100, the supply will not react for a decade. We are stuck with the supply we have, and the supply we have is falling. Mine production has been flat or declining for years. Ore grades are falling. We have to dig up more rock to get the same amount of silver. This is peak silver. Combine falling supply with exploding demand, and you have the recipe for a super spike. A super spike is not a normal bull market. It is a vertical repricing event. It happens when the market realizes that there is physically not enough material to go around. It has to ration the remaining supply by raising the price to a level that destroys demand. But wait, industrial demand is inelastic. You can't destroy it easily. Apple will still buy silver at $500. So the price has to go even higher to find the point where someone finally says, okay, I stop buying. Who stops buying first? The investor? Maybe. The jewelry buyer? Probably. But the strategic industries? They will be the last to stop. This suggests that the ceiling for silver is much, much higher than anyone thinks. The old all-time high of $50 is a joke. Adjusted for inflation, that $50 in 1980 is like $150 or $200 today. We are nowhere near the real highs. We are just getting started. So, what should you do? What is the actionable advice? Step 1. Get physical. If you don't have a core position in physical silver, get one. Don't worry about the spot price. Worry about getting ounces in your possession. Look for generic rounds or bars. These have the lowest premiums. Don't buy fancy coins, buy weight. Step 2. Diversify dealers. Don't rely on one shop. Have a relationship with a local coin shop, LCS. Have accounts with 2 or 3 major online dealers. When the squeeze hits, some dealers will have inventory and others won't. You want options. Step 3. Watch the ratios. The gold to silver ratio is your compass. If it's high, above 80, buy silver. If it drops low, below 40 or 30, consider swapping some silver for gold. This helps you lock in profits and move to a more stable asset without going back to fiat currency. Step 4. Prepare your mind. This is the hardest part. You have to be mentally tough. You have to be able to watch your portfolio drop 20% and not panic. You have to be able to watch it go up 50% and not get cocky. You have to stay humble. Markets punish arrogance. Step 5. Have an exit strategy. You don't have to sell everything, but you should have a plan. If silver hits X, I will sell Y% to pay off my mortgage. If the gold-silver ratio hits Z, I will swap half my stack for gold. Write this plan down. Do it now while you are calm. When the mania hits, you won't be able to think clearly. Follow your plan. I want to talk about the social aspect of this. When silver goes viral, everyone you know will want to talk about it. Be careful. If you tell everyone you have a stack of silver in your house, you become a target. Keep your mouth shut. Stealth wealth is the best wealth. You don't want to be the guy who gets robbed because he bragged on Facebook about his monster box. Also, be prepared to help your family. They will come to you when they realize their paper money is dying. They will be scared. They will be confused. You can be the lighthouse in the storm. You can guide them. You can help them preserve what they have left. This is a responsibility. Don't just say, "I told you so." Help them. We are living through a fourth turning, a crisis period that happens every 80 years or so. Institutions crumble, trust evaporates, the old order dies and a new one is born. Silver and gold are the bridges across this chasm. They survive the death of the old system and they buy you a seat at the table in the new system. This is not just about getting rich. It is about survival. It is about sovereignty. It is about freedom. The warning in the video title, Investor Warning, is real. The warning is not that silver is bad. The warning is that the game is changing. The rules you learned in the last 40 years, buy bonds, trust the Fed, save in dollars, those rules will destroy you in the next 10 years. You have to learn the new rules, the rules of scarcity, the rules of tangible assets. The supply is drying up. That is a fact. The demand is soaring. That is a fact. The price is moving. That is a fact. Do not let the volatility scare you out of the trade of a lifetime. The engine of the silver market is sputtering, but that is because it is running out of cheap fuel. It is about to switch to rocket fuel. When the history books are written about this era, they will talk about the great repricing. They will talk about how the illusion of paper wealth evaporated and the reality of physical wealth asserted itself. You have a chance to be on the right side of history. Don't blink. Don't panic. Just stack. The window is closing. The physical metal is disappearing into strong hands. Are those hands yours? Or are you going to be left holding a paper receipt for a claim on a bar that doesn't exist? The choice is yours. The time is now. The storm is here. But inside the storm, there is opportunity. The greatest opportunity of our lives. Take it.